Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is Your Course to Retirement with Grand Rapids Resource for a common sense approach to planning for our financial, our investment, our retirement futures. He is president and founder of Cornerstone Retirement Partners, certified financial planner, CFP. Ron Corser here to help uncomplicate and clarify the financial world. And Ron, there's a lot of mud to sift through right now in the financial world, it seems like.
For the first time in a long time, Peter, you've just scared me. But first, I want to welcome everybody to today's program. We're going to cover a lot of really interesting stuff. And I think some of it is going to be applicable and some of it may be a whole different world. But it's important to understand what happens when all that high-priced talent in Washington, D.C. starts talking about making changes to the tax code. So we're going to talk about changes to the tax code. We're going to talk about how to review all of this stuff. It's interesting when we think about taxes. What most people say, well, did I pay a lot in tax? And when I ask that question to them, it depends on, did they get a refund or did they have to pay? My mom was a great one. I tell this story. I might as well tell the story about my mom, bless her heart. She always would go with my Aunt Helen to get their taxes done. And this was a giant spiritual experience because they would go to get their hair fixed. And with my aunt, we never knew exactly what color her hair was going to be. And sometimes my mom would change colors too. So they would go to the hairdresser, then they would go have lunch, and then they'd go see the tax lady. And I could have done their taxes in like 5 minutes. It just wasn't that complicated, but that was what they did. And I got a call one time from my mom. This was way back in the day, 1996 to be precise. She called me up and she left a voicemail. My mom never leaves voicemails. She hated that. But it was, Ronald, call me. Now, my mom could say my name, Ronald, in such a way that would make me wilt, and I'd become this 5-year-old kid with snot running down my nose. So I called her and I said, Mom, what's going on? She said, that stupid thing you did in the stock market for me, I had to pay tax. I said, Mom, what are you talking about? Well, here's what she was talking about. 1995 was an incredibly wonderful day and year in the market. And I had purchased some of her money to put it into a mutual fund. And the mutual fund had a great gain, and it also had what we call phantom income, right? Dividends, interest, capital gains inside. It produced a 1099, which caused her for the first time in years to have to pay tax. And she kind of went up one side of me, down the other. When she was done, she says, and your aunt, you did that stupid thing with your aunt too, and she's mad at you, and she's going to talk to you when I'm done. So I have to listen to my aunt now. So I said, what do you want me to do, Mom? She said, I just want that stupid stock market thing out. So we sold it and created another tax issue the following year, but it worked out okay. So what I bring that up is everybody perceives tax rules based on their own experience. It really doesn't matter to us as human beings, does it? It doesn't matter to me what's going on in your tax world, Peter. It only matters to me what's going on in my tax world. And one of the things I always encourage people to do, though, is to make your tax preparer work for you. What do I mean by that? We sit with our tax person, our CPA, 3 times a year and do what's called tax forward planning because we're making decisions all the time that are going to have a taxable implication, if you will, an impact on our bottom line. So we meet with them every so often, and we say, this is what's going on. What do I got to do? What makes sense? I encourage everybody right at the top of this program to just kind of write down or make a mental note that going forward, you're going to use your tax preparer for more than just saying, here's all my stuff from last year. Figure out if I get a refund or don't get a refund. Because what happened last year, you can't change. So here it is, the middle of November. There may be some things you can still change now. So always use your tax preparer. Pay them extra. They love it. Pay them extra to do work for you that'll help you with taxes. So that's my little religious statement for Sunday when it comes to taxes, and we can go forward from there. But anyway, if anybody's interested in talking about phantom income or what happened to my mom, give me a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-retirement.com. rp.com. Put your information in there. Be more than happy to chat with you. It's not too late to do some things that might have a real tax benefit for you this year. So give us a call, 616-301-2581.
Now, if we could just get everyone's mom to call them and tell them to call that number in their mom voice, I think we'd have a whole lot more calls, and tell them how important it is.
Heavily medicated and institutionalized for at least the end of the year.
Using middle name and all, right? You've got to have the full name.
Moms can call their kids by their name, and they do it in such a way that it just puts the fear of the Lord in you,
Does.
So anyhow,
Yep.
That was something she did on occasion.
My mom's got that voice as well, but I do have to question here, Ron. She owed taxes because she made a profit. It's just she disliked paying the taxes and owing the tax man enough that she'd rather not make the profit.
She made a lot of money that year. She really did, but it didn't matter to her. It absolutely didn't. And see, that's the interesting thing, isn't it? A lot of times in our industry, we put forth information and facts and data, and we expect everybody to respond in a certain way to it. But when we get right down to it, what we do about our tax situation is really a personal thing. My mom did not want to pay. She wanted to get a refund. There's a lot of people out there who are in the same kind of situation, same mindset. But it's always about what we think. It's not about supposedly what I might say to somebody, this is a really good tax savings idea. They may not be comfortable with it. They may not like it. Who knows what? It's always about how we perceive things and what's right for us in our own eyes. So don't ever allow yourself to be the receiver of critical advice because perhaps you didn't do something. I never do that with people. Sometimes when we go through tax returns from previous years, I'll ask simple questions. Do you know what this line means? Because this was extra income from a 1099 account. Are you content with that? Are you happy with that? So understand, this is when you talk about taxes, it's not a beat 'em up. It's really just try to understand. Let's talk about what the rules are, what your current situation is, and what you're comfortable with. And if you're comfortable with what you're doing and how you're doing things, like my mom was, bless your heart, you're going to be just fine.
Well, again, if you would like to be in touch with Ron Corser, a certified financial planner, as well as the rest of the team there that works to help Grand Rapids area savers and investors be more knowledgeable, make better decisions with your money, have a plan for your financial future that makes sense for you and your situation, pick up the phone and give a call, 616-301-2581. That's 616-301-2581. Now, Ron, back in 1995, 96, it seems like taxes were a little bit of a simpler subject and topic. We were all under the pretense and under the assumption that in the future we will be paying lower taxes. We'll have lower taxes once we retire, and it won't be as big of a factor, cost or expense. However, today we are seeing a lot of different language and a lot of different thoughts behind how we should be preparing for taxes into the future. 26 years have passed and the environment for taxes has changed. And so as we are looking at the world around us today, what do we need to be doing or thinking about or preparing for when it comes to taxes?
Well, there's a lot of things we can do. A lot of it gets down to let's figure out where we are right now. So here's number one in terms of advice is take a look at what kind of income you're making through the past month. See where you stand on that. Number two, then figure out what are the things you can do to reduce taxable income. So what can that be? I can put more money in my company's employer-sponsored plan, into a 401k, 403b. Depending on income, I can maybe make a contribution to an IRA, which is tax deductible. If I have a brokerage account, not a tax-deferred investment account, but a brokerage account, are there some things, maybe some securities, some stocks, and mutual funds that I've had that are in a loss position right now? You could sell those potentially and create a tax write-off to offset some of the gains perhaps you've had in those. So those are just three simple things that anybody can do very quickly. So figure out what your income level is going to be, or at least has been so far for the first 10 months. Figure out where you might put additional dollars if you want to reduce your taxable income. But understanding, if you think taxes are going to go up in the future, you have to kind of balance that. Do I save some tax dollars now or wait for the future? And then take a look at if you have an investment account that's had some losses, can you sell those and create carry forward losses that offset some gains that you may have had? So those are three simple things that everybody can do with their tax portfolio. Now, If you're not sure how to do that, give your advisor a call. I mean, we're going through this now with our clients. So give your advisor a call, make them work a little bit for you and say, are there some things I can do to do some tax harvesting that'll make it easier for me this year?
Now, Ron, at Cornerstone Retirement Partners, are you inviting and experiencing those calls?
Yes, particularly when we go through the required minimum distribution scenario, which leads very easily into the whole idea of what about creating some tax benefit for us? Because some people are now in the process of deciding, okay, let's do the required minimum distribution. Well, that's a taxable event. So that leads nicely into saying, you want to take a look at some of the rest of the accounts because maybe there's some ways we can minimize the impact of that required minimum distribution or minimize using some other strategies of giving some or part of that required minimum distribution away as a qualified charitable deduction.
RMDs, required minimum distribution. Ron, to me, there is no other time that really emphasizes the fact that the IRS is the managing partner of your retirement account than when they tell you, you must take some money out of this to pay us off.
Yeah, and really interesting about that, not only are they your partner in it, but they get to make up the rules and they get to change them anytime they want. And we're going to spend a little bit of time on today's program talking about some potential rule changes when it comes to IRA accounts, both regular IRA and Roth IRA accounts, because there's a lot of information out there, a lot of what I call noise as to what's going to happen and what's not going to happen, who may be impacted. But here's what I want to stress with everybody listening to today's program. It really doesn't matter where you are today in terms of your tax status or bracket. It doesn't matter. Why do I say that? Is because ultimately, all the taxes that they come up with income, that's always prefaced with, it's only going to be for the really wealthy. It's only going to be for these mega trillion gazillionaires. All of that ultimately filters down to the middle class. Since 1913, when we had the first tax law written, taxes always end up thumping down on the middle class. Why? Because in savings accounts, tax-deferred IRAs, Roths, or not Roths, 401ks, things like that, it's been estimated as between $22 and $25 trillion out there, yet to be taxed. Think about that number. What's the deficit? About 25 trillion, right? That's a great number. And the politicians want to get at that number, not so they can pay down the debt for the country, but so that they can increase spending for what they want to do. So understand that today a tax rule may not hit you, it may not impact you, but if you live long enough, these things are going to filter down. So we're going to talk about some of the things that are in the view right now, so to speak, in headlines, and see if it makes any sense to say, wow, maybe that's something I got to be aware of. So if you want to talk about your accounts, tax returns, we're not CPAs, but we do have tax software that we can help people with to do Roth conversions or just figure out what we need to do in terms of investment strategies. Give us a call, 616-301-2581. That's 616-301-2581. Or go to our website, www.cornerstone-rp.com. Put your information in there and we'll contact you and we'll do our very best to help you.
Couple great ways to be in touch with a sound financial resource, ladies and gentlemen. Certified financial planner Ron Corser and the entire team there at Cornerstone Retirement Partners. They serve as Grand Rapids resource for that common sense approach to planning, basic planning, advanced planning, everywhere in between. It's never too early, never too late, never too much or too little to get that plan put together to improve your outlook for your financial future. And they are the resource to help you. Give them a call, 616-301-2581, 616-301-2581. You can also visit online, cornerstone-rp.com, cornerstone-rp.com. And when we come back after this quick break, we'll talk about the proposed tax law changes and what you need to know with Ron Corser in just a moment.
Can you hear that? That's the sound of you setting off on new adventures on the trip of a lifetime that you always dreamed you'd take in your retirement. You worked hard to be able to enjoy these kinds of experiences, and now you can. In fact, you can even enjoy a few upgrades and extras along the way. A big part of this is due to the confidence you feel in the careful planning and mapping out of your retirement with your fiduciary team at Cornerstone Retirement Partners. By sitting down with Ron, Nolan, and the team at Cornerstone Retirement Partners, you created your plan and carefully looked at your income, investments, taxes, health care plan, and it looks like you'll even have a little left over to leave a positive legacy for your loved ones. Now that's enjoying retirement with confidence. For your complimentary planning review and written retirement income map, Set up a time to speak with Cornerstone Retirement Partners at 616-301-2581. That's 616-301-2581. Or visit cornerstone-rp.com for your complimentary investment analysis and retirement planning session.
And we're back here on Your Course to Retirement, Cornerstone Retirement Partners, your resource, ladies and gentlemen, for a common sense approach to planning. CFP, Certified Financial Planner, Ron Courser with us on today's edition of the program. And we are talking about your money, your income, your taxes, your financial future, and how to plan appropriately. In the first segment of the program, we learned about Ron Courser's mom's approach to taxes and what she thought of making money versus paying taxes in her investments. But maybe a couple listeners out there, Ron, have a slightly different take on that. And as we are considering our own take on taxes, we need to understand some of the proposals that are being put forth in Congress and the potential changes that they would have to our taxes and our taxable income and our retirement accounts into the future.
Yeah, and they're potentially very big ones, especially if you're a well-heeled investor. But like I said earlier in the program, when the tax rules start to apply only to the very wealthiest that the politicians tell us, eventually those rules land right on top of us and potentially can crush us if we're not ready for them. So a couple things going on down there, which a lot of people perhaps have heard. Number one, they want to get after those evil wealthy people that have more than $10 or $20 million in their IRA. This came across because of a guy named Peter Thiel, who was a hedge fund guy, who purchased a startup company for 1/10 of a penny. He bought stock, and this thing went from peanuts to billions. And so obviously in this environment we're in politically, where people with money are basically evil at the very, very lowest level, they want to change that. So they've got all hot and bothered and made a bunch of changes potentially. And they're going to do a couple things, and here's the top line, so to speak. Number one, if you have an IRA with more than $10 million, or you're a accredited investor, you make as a couple more than $450,000, you may have experience a higher required minimum distribution annually than what it is now. And furthermore, you may be prohibited from even adding to that. Now, somebody who's got 10 or 20 or $50 million in an IRA probably are not going to get too upset that they can't put in a $6,000 annual deposit into their IRA.
Seems rather insignificant, actually.
And that's how insane these psychopaths on Washington.
But they did something. They did something.
Yeah. Oh, you got it. You can't do that. That'll fix it. But there's something that could impact people, and that's called a backdoor Roth. What is a backdoor Roth? Here's a way that it can be easily done. You create a non-deductible IRA. Right now, there are no limits on it. So you just put taxable money into a non-deductible IRA into a non-IRA account. You can then turn around and convert that money to a Roth. Since you've already paid tax on it, the only tax you might pay on it is if there was some growth in that account. Now, where this might come in to impact people, because we have some clients that have it, is they're still working in corporate America, and they've made non-deductible contributions to their 401k with the idea that at some point in time, they're going to roll that out and convert it to a Roth. This new legislation is going to prohibit that, apparently. There's still some details that need to be ironed out. But my solution to this whole thing is to say to anybody, if you have non-deductible money in your company retirement plan that you had planned on converting to a Roth at some point in time, you may want to take a look at it and doing it sooner than later, meaning this year, just to be on the safe side, because some of these things are not going to be retroactive, but they will be implemented beginning in 2022. So that's a little nugget there for those of you listening to the program today who have retirement, non-tax deferred retirement money in your 401k. It could be in any form or source, but you may want to think about rolling that out if you can sooner than later. Now, they also call it a mega backdoor Roth, where you could actually do $56,000, $57,000. They're probably going to put the kibosh on that one too. For most people, these rules are not immediately going to impact their life. But the problem comes down the road. And here's what I mean by that. And when we have Roth discussions with our clients, two things I hear from people: well, they're going to change the rules on taxes. And number two, they're going to make some other goofy changes to it. My response is that they're not going to change the tax status of a Roth IRA. That will make everybody crazy and will vote them all out of office. What I believe they will ultimately do, it's just my opinion, is they will say somewhere down the road, no more Roth accounts. And they're already talking about it in this current legislation. They already are. And one of the parts to that is they're saying, okay, this whole issue of Roths and conversions and everything, we're going to postpone it until 2031 or 2033, some 10 years down the road. But the rule is still there to eliminate Roth accounts. Why do they want to do it down the road? A couple of reasons. Number one, it makes it easier to put a cost on this giant $1 trillion tax bill that they're passing. Number two, it encourages people to continue to convert money, because when you convert money, that creates more tax dollars. But the fact that they're thinking about putting this in the bill, I think supports the idea that if you don't have a Roth, it'd be a good idea to create one today, because they may, in fact, eliminate it either 5 days from now into the 2022 season or 10 years from now, who knows what. Or they could say, well, we changed our mind. Instead of 2031, we're going to back it off to 2026. Who knows?
Yeah.
So I think it's important for long-term planning to create a Roth account.
Ron, as you are mentioning that, obviously the $10 million or $20 million in my IRA doesn't apply to me personally, but as you're talking about these changes, what it does ring in my mind is that it legitimizes the strategies that are in place and the value of and the necessity of having those accounts set up and established. And then over the course of the next 10 years or however long that window is, the importance of trying to get everything that we can into those accounts. So whether or not that wealth level of $10 or $20 million applies to you or not, ladies and gentlemen, I think that the point of these laws and what we should digest and think about when we look at them is that obviously there is some value to those type of accounts, and there is some strategic planning, Ron, that should be done while we've got that window of opportunity open and available to us, regardless of our wealth level.
Yeah, I agree with that. And here's what I call a little nugget. We have a lot of clients that are officially retired, but they work part-time. You can always put money into a Roth IRA as long as you have W-2 taxable income. So you could be 74 years old and driving, flower bed around in the springtime to earn a little money. You can put that up to $6,000 a year if you want $7,000 into the Roth account. So you always have an opportunity to continue to do that. You can also do it with IRAs, but that doesn't make a lot of sense from my point of view when you're already retired and just making part-time money to just put more money into a taxable account. So it's something to think about. So if these things are kind of hitting a little button with you, ladies and gentlemen, give us a call, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there and we will contact you and help you the best way we can. Now, here's the promise I made. I don't know if we'll be able to improve your current situation, but if you do spend a little time with us, we'll be able to answer all your questions, so you'll feel a whole lot better about what you are doing.
Well, again, the number, 616-301-2581, 616-301-2581, 616-301-2581. And there is a second half to this program. Hopefully you can stick around for the full thing, but always your resource and your way to get more important information is to contact the team from Cornerstone Retirement Partners directly by giving a call to that number, 616-301-2581, or visiting online, cornerstone-rp.com, cornerstone-rp.com. CFP Certified Financial Planner Ron Corser and the team there at Cornerstone are your resource, ladies and gentlemen, and can help you structure that plan or double check and review your current plan to make sure that you are doing the best things with each and every dollar. 616-301-2581. Quick break. We'll be back with more with Ron Corser. We'll talk about some year-end tax deadlines as well as some other strategies that you need to be aware of and potentially act on given your situation when we come back here on Your Course to Retirement.
Can you hear that? That's the sound of you setting off on new adventures on the trip of a lifetime that you always dreamed you'd take in your retirement. You worked hard to be able to enjoy these kinds of experiences, and now you can. In fact, you can even enjoy a few upgrades and extras along the way. A big part of this is due to the confidence you feel in the careful planning and mapping out of your retirement with your fiduciary team at Cornerstone Retirement Partners. By sitting down with Ron, Nolan, and the team at Cornerstone Retirement Partners, you created your plan and carefully looked at your income, investments, taxes, health care plan, and it looks like you'll even have a little left over to leave a positive legacy for your loved ones. Now that's enjoying retirement with confidence. For your complimentary planning review and written retirement income map, set up a time to speak with Cornerstone Retirement Partners at 616-301-2581. That's 616-301-2581. Or visit cornerstone-rp.com for your complimentary investment analysis and retirement planning session.
And we're back here on Your Course to Retirement, the second half of the program this week with Ron Corser, your certified financial planner, a CFP resource for you, ladies and gentlemen. Does not charge for time for listeners to this program to get an initial review and evaluation, and that time could easily go upwards of $1,000 to several thousands of dollars. But for radio show listeners or podcast viewers, Ron and the team there at Cornerstone Retirement Partners willing to waive all fees, charges, any costs so that you can get a feel for who they are. They can help to point you in the right direction financially and identify any strategies that would make your financial path and journey a little easier or to optimize it. And if you would like to take advantage of that offer, pick up the phone, give a call, 616-301-2581, 616-301-2581. One area, Ron, that we are focusing on today that I feel like everyone feels they could have a little better outcome is in the world of taxes. And we've talked about some of the tax proposals that are on the table. We probably will circle back to several of those, but before we do, to start this second half of the program, we want to talk about some year-end tax deadlines. There are some things that we can sort of kick the can down the road and delay on, but there are other hard deadlines with tax execution and planning, and we definitely want to make sure that we're taking care of those before the end of the year and in a timely basis.
Yeah, so let's talk about them one at a time. Let's talk about the required minimum distribution, the RMD. Basically, who is subject to having to take an RMD, a required minimum distribution, out of their tax-deferred account? Anybody that really was born in 1949 or earlier now. So the required minimum distribution is a government rule that says there's a certain amount you have to take out. It's the least amount, but you have to take it out so the government can tax it. And this year, if let's say you're 72 and the required minimum distribution is there, the first year is 3.91% of all your tax deferred accounts. So you can have 5 IRAs. They just add up the value of those the previous December 31st, 2020, and they figured out based on 3.91% what your total number is. You can take that from one account or all of them account, it doesn't matter. Now, the one difference comes with 401k plans. So if you're still working or you have a 401k plan you haven't transferred, you can't roll that into the IRA stuff. That has to be a separate deduction or separate requirement distribution for you. So don't get confused. Well, I have all this tax deferred money, it's just going to be one number. No, IRAs, you can combine all of them. 401k, you have to take it out of the 401k plan if that's appropriate and required of you. So Don't get confused with those two issues.
So Ron, just to maybe just restate this, 5 IRAs, 5 separate IRAs, it's okay to take an aggregate amount out of one of them, but 5 IRAs and a 401k, or even just one IRA and a 401k, we are going to have to take 2 separate distributions,
Correct.
Essentially because those are different types of qualified accounts. Now that 401k could eventually become an IRA, but because for the time being, they are 2 separate types of retirement accounts, 2 separate RMDs would be required.
Yeah, it's a quirk in the law. You sit back and you say, how can somebody create stuff like this? And I think you just have to answer and say, you know what, that's what bureaucrats do.
Because they're paid enough up there in Washington to do
That's right. They make things complicated and then they try to solve it. So the requirement distribution is important. It has to come out of your account, not later than the 31st of December. Now here's a little red flag warning. For those of you who still haven't taken it, I would encourage you to do it sooner than later. Why is that? Every once in a while, a mistake can be made in paperwork. Something could go wrong. You don't want it to go wrong on the 29th of December, and then you don't have an opportunity to take it out. Because if you don't take it out, you're going to be subject potentially to pay a tax penalty of 50% of what you didn't take out, and you're still going to be forced to take it out. So it can be kind of expensive. So what I tell people is I would really encourage you to get it all done by Thanksgiving. That way, if paperwork gets lost, something goes wrong. Think about this. The human beings working for the custodians who hold your IRA accounts, they're human beings. They got families, they got kids, they got stuff going on, vacations, got a lot to do. And just sometimes things can go wrong and you don't want to put yourself in that position. So that's the first one. Second one. It deals with IRAs and Roth conversions. So if you're going to do a Roth IRA conversion, if you're going to convert some money out of your IRA and put it into a Roth and pay tax this year, that whole transaction has to be completed by the 31st of December this year. So conversions have to be done in this calendar year. There's no recourse if you miss it or mess it up. Again, it would be really a good idea to do it sooner than later. There are some custodians, and who's a custodian? They're just the people that hold your money, who said they're not even going to accept paperwork this year after Thanksgiving. Why? Because COVID and having people work every day is creating problems. We all know that. So do it sooner than later. Now, that takes Roth conversions. Now, let's kind of switch gears a little bit and go to IRA or Roth deposits. It's a different animal. You can make a Roth or an IRA deposit into your account up until tax season ends next year, April 15th, and still have it qualify as a 2021 deposit. So that's where these two rules kind of get a little fuzzy. If you're going to do a conversion, you need to do it this calendar year. No ifs, ands, or buts. If you're going to do a deposit, and a lot of people wait to do their tax returns and figure out if they're going to put money in their IRA, you can do that up until tax filing season is done on around the 15th of April. So those are two things to be aware of. So if you're interested in talking more about these kinds of things, doing Roth conversions, we have software to help clients figure out, number one, does it make sense? Number two, if so, how much? And number three, what kind of a strategy do we need to create over a period of years to make this Roth idea really work on our behalf? Give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your name and number in there and we will contact you and help you just as fast as we can. But keep in mind, this COVID thing, we read about restaurants not being able to find help. The same thing's going on with custodians. So do it sooner than later.
Indeed. Always good to be proactive. And these are things, again, that have a hard deadline, ladies and gentlemen, not for when you submit the paperwork or the request, but when they must be completed by, and there are even some restrictions with your institutions perhaps that they need a little bit more advanced time. So get the ball rolling, get the ball started on these things now if they are in the cards for you, if they are in consideration with RMDs, required minimum distributions. And basically, if you have $1 in a tax-deferred account and were born in 1949 or before, here is your reminder if you need one. RMDs are back on again for 2021. We got to skip them in 2020 because of COVID, but they are back as required in 2021. And it may be your first year, or you may have been doing it for many, many years prior, but this year, it's required again. Let's make sure to get the ball rolling on that if that applies to you. And Roth conversions, while contributions, new dollars into IRAs or Roth IRAs, are kind of a different animal altogether. If you are looking to take advantage of 2021 as an opportunity to make a conversion, which, as we talked about in the first couple segments of the program, may be a very good idea for you, ladies and gentlemen. Again, that's got a deadline of December 31st, the end of the year, and it takes time to make that happen. So start sooner rather than later. Get with your financial professional, get with your tax professional, look over these strategies, these opportunities, quantify what it may mean for you, how much would you like to convert, how much will it cost you, and then get executing on those decisions now so you can make sure that you've done that and completed it by the end of the year. Ron Corser, of course, here to help his current clients at Cornerstone Retirement Partners. But even if you're not yet a client, there's probably still time for you to look this over and figure out if either of these moves are applicable to you or would be beneficial to you. Give a call, 616-301-2581, 616-301-2581, 616-301-2581. Ron, another one, I know you mentioned this in the first half of the program, but those qualified charitable distributions, another one with a year-end deadline. That contribution to a charity, a church, a nonprofit organization, it must be done and completed within the calendar year.
Yeah, it's a really good thing to take a look at for everybody. There's a lot of people who are charitable minded. And sometimes they get to a situation in life where they're forced to take out this required minimum distribution, but they don't really need the money. But on the other hand, they're giving money away after tax dollars to church or qualified charities of different kinds. One of the nice ways you can kind of minimize your tax burden is to designate some or all of your required minimum distribution to a legal charity. You still have some time to do it, but I would, like everything, do it sooner than later. And what that means, let's say you have a required minimum distribution of $4,000 this year. You can designate some or all of that to go to a charity of your choice or several charities. The record for us as a client is he had 7 different charities that we sent money to. So there's a process that we follow to create the paperwork to do that. It's not difficult, but what it does do is if you have that $4,500 RMD, the required minimum distribution, and you give it away to charity, it doesn't even show up in your tax return. It's not a taxable event. So it makes more sense from a tax perspective to give away pre-tax dollars than after-tax dollars. So, and I'm quite sure, as best as I can be sure, I tell people this, I don't believe Jesus minds if you give away money and you get a deduction with it. I think that's okay. So don't be shy about doing that. But it's a way to help. It's a way to help a charity of your choice, and it's also a great way to help you with this thing called tax return discipline. It'll help you.
Now, Ron, your record there, seven different charities from a single client within a given year, which is fantastic and good for them. However, not on the list here. We're speaking about year-end tax deadlines, and certainly that qualified charitable distribution. It falls into that categories. But I believe so also does gifting to individuals. And for those that may be looking to get some money out of their estate for whatever reason, there is a limit to how much we can gift within a year. There's also a separate limit for how much we can gift over a lifetime. But if we get it out this year, then I believe that now that money is excluded, and we could do that to unlimited individuals. We can pay and give gifts of, I think, up to $15,000 to family members, to children, to grandchildren, to friends, acquaintances, maybe people we don't even like, just to have them leave us alone. We could pay them off for that, and it is a tax-free gift, and then gets the money out of our estate. So there are reasons why we would want to consider not just for charitable distributions, but gifting to individuals as well, correct?
It is, particularly if you believe that high-priced talent in Washington, D.C. is going to do something about the estate tax. Right now, a couple can shelter almost $23 million from the estate tax. There's a lot of people who think that's going to change. I'm one of them because it's a political issue. I don't know what they'll do about the small farmer that they all seem to be so concerned about, except when it comes time to pass the bill, then they don't give a rip. But the more you can get out legally now, the better off you're going to be. And so it's depending on how complicated your estate is. You may want to really hurry up before the end of the year to do some of that. But the more you can do now this year, the better off you're going to be down the road. That's a great point.
Another one on your list here for year-end deadlines, if we are working for an employer and there is an employer-sponsored plan, individual contributions to IRAs and Roth IRAs, those can be done up until the tax filing deadline. But if $1 goes into that employer-sponsored plan, it counts only for the year that contribution falls within, correct?
That's true. And some plans allow for what we might call a bigger drop into the account. So for example, you're taking money out of your check that goes in there and it's deposited. Some companies, and we're one of them, we allow employees to make a lump sum deposit, if they will, of any amount up to the legal limit, just by writing a check. Some companies, a lot of them won't do that because it messes up the process for payroll. I get that, but the rule says you can do that. So somebody wants to put in a little extra in their 401k, the 401k Roth, you can very quickly, and I've had a couple of people actually do this. They've just said for the next month, we're going to deposit 100% of our payroll deduction into our particular account. A lot of people use it more for the Roth if they have a 401k Roth, so they can pound as much into that account as possible. So you may have to jump through some hoops. A lot of times with 401ks, the individual participant has the ability to go online and make changes themselves. So that makes it a little easier, but it's another way where, if you can afford to do it, you can take that last paycheck or two and really put in a whole bunch more into your account. And it's a great way to save.
Well, again, these are year-end deadlines, ladies and gentlemen. So if any of these do apply to you, get started in that process much, much sooner. And we would encourage you to get started in that process now. And if you've got questions of if any of these apply to you or would be beneficial for you, that's what the team from Cornerstone Retirement Partners is there to help you determine. Pick up the phone, give them a call, 616-301-2581, 616-301-2581, 616-301-2581, or you can go online, visit them at cornerstone-rp.com, cornerstone-rp.com. A few questions get submitted for the program from time to time, Ron, and we've had a number of those that are related to taxes and wanted to touch on a few of those here as we sort of round the corner and into the home stretch of the program. Maybe one time to get to one before the break here. A beneficiary received an IRA proceeds, and has 10 years to liquidate the account. If they turn 72 within those 10 years, must they take the RMD amount, or are they free and clear because it was inherited in the first place?
No, all inherited IRAs have 10 years from the time you get them. From the time of death, you have 10 years to liquidate it. It doesn't matter if you just turned 72 this year. You got that 10-year window, and that includes for non-spouses. This is non-spouses, that 10-year issue, plus a couple others kind of sectors. You have that 10 years, even if it's a Roth. The whole ruling came about with the Secure Act. It was based on the assumption that these accounts were retirement accounts. They weren't supposed to be for, giving away to kids or grandkids or things like that. You can have a political debate on here. This isn't the time for that on that. But you have 10 years to liquidate it. You can do as much or as little. If the longer you wait, you could literally wait till the day before the 10-year time. And then you have You get a lump sum, but that becomes if it's a tax deferred account, like an IRA, that becomes an enormous tax hit on you. So it requires a little bit of planning. Generally, what we do with our clients is we still set up systematic withdrawal, as if this rule never came into play. They get the income and it's set up so that by the end of the 10th year, it's pretty much liquidated and we avoid a giant tax liability.
Yeah, if you wait to take it all in 1 year, you may push yourself into a significantly higher tax bracket versus if you spread out the distribution over the full 10 years that are available. So again, individual case-by-case basis, but something that needs careful thought and planning and execution. And certified financial planner Ron Corser and the team from Cornerstone Retirement Partners there to help you through that. Pick up the phone, give them a call, 616-301-2581, 616-301-2581. And I actually imagine, Ron, that a lot of people are going to be impacted from this. If I have to sort of imagine when a lot of wealth is being transferred, a lot of those retirement accounts may pass to a next generation. It probably will be within kind of a 10-year window of when the recipient themselves are nearing or entering into required minimum distribution sort of time frame. So an important question to clarify there, are RMDs then required on that inherited IRA, or can we take advantage of that full 10-year window? We can. But is it the best thing for you? That's what you need to find out individually and specifically for your situation. And Ron Corser, a certified financial planner, here to help you through that. Pick up the phone, give a call, 616-301-2581, 616-301-2581. Quick break. We'll be back with a few more questions and wrap up the program here as we have been talking all things taxes, the tax law changes, the year-end deadlines, and what you need to know, ladies and gentlemen, here on Your Course to Retirement. Don't go anywhere. We'll be right back.
Can you hear that? That's the sound of you setting off on new adventures on the trip of a lifetime that you always dreamed you'd take in your retirement. You worked hard to be able to enjoy these kinds of experiences, and now you can. In fact, you can even enjoy a few upgrades and extras along the way. A big part of this is due to the confidence you feel in the careful planning and mapping out of your retirement with your fiduciary team at Cornerstone Retirement Partners. By sitting down with Ron, Nolan, and the team at Cornerstone Retirement Partners, you created your plan and carefully looked at your income, investments, taxes, health care plan, and it looks like you'll even have a little left over to leave a positive legacy for your loved ones. Now that's enjoying retirement with confidence. For your complimentary planning review and written retirement income map, set up a time to speak with Cornerstone Retirement Partners at 616-301-2581. That's 616-301-2581. Or visit cornerstone-rp.com for your complimentary investment analysis and retirement planning session.
And welcome back into the home stretch here of Your Course to Retirement. Grand Rapids, your resource each and every week for education and a common sense approach to thinking about your money and how to handle your finances, your investments, and your retirement planning are the team from Cornerstone Retirement Partners. They offer that insight here on the radio and through the podcast, but also for you individually, specifically and in person. And if you would like to take them up on the valuable offer and opportunity for that complimentary review, all you need to do, pick up the phone now and give a call, 616-301-2581, 616-301-2581. Recapping, Ron, we have been talking all things taxes, what we need to know, what we need to do, what we need to think about and be aware of as far as where taxes are and where they may go into the future. Year-end deadlines, we covered a lot of those. One thing that I do want to mention, taxes are important. It's not what you make, it's what you keep, but they are probably the biggest factor in between those two. However, it is a byproduct of income or growth. So what you make is important as well, and that's where the income planning for retirement, the mapping out of how to create income, and the investment selection is equally, if not more important, or at least on the balance together are the growth of our assets, our income, and our investments, and then the taxation of them as well.
You know, it really is. And I'm going to encourage people right now here in the middle of November is take a look at last year's tax return and see if you had what we call 1099 taxable income. We call it phantom income. It's what happens if you own a mutual fund or a taxable account with stocks, capital gains, interest, dividends. You may not have spent that money. It may have been reinvest it in your mutual fund, but it's going to give you a tax bill at the end of the year. If you had some last year, chances are this year you're going to have more. So it may be really beneficial to talk to somebody sooner than later about, is there something I can do now to minimize the tax issue? It may not be possible because a lot of the distributions and 1099 has been etched in cement right now, but it gives you an idea of what you can do going forward. Mutual funds in and of themselves are basically mostly tax inefficient. Now, there's also some that are going to be very efficient, but generally as a rule, they're more tax inefficient as exchange traded funds. And there's a lot of exchange traded funds that mimic the mutual fund. So you may want to make a decision to say, wow, I got all this income. I got to pay tax on it. I'm not spending it. Maybe I need to talk to somebody about reconfiguring my investment plan to somehow minimize this phantom income, if you will. And if that's important to you, ladies and gentlemen, it is important. It can make a big difference in your tax bill going forward. It may be too late now this year, but it's never too late to do something about it. Give us a call at 616-301-2581. 616-301-2581. We are not tax preparers, but I'm a certified financial planner. We have tax planning software in our firm, and we're perfectly capable of giving you a reasonably good estimate of what kind of tax bill you're going to get and maybe help you make some decisions on how to minimize that to give you more income, pay less tax, and that's never a bad idea. So give us a call if this is important, 616-301-2581. One of the things I tell people, it's difficult as a financial advisor to give financial advice on investments without having some idea of the tax implication of that. You know, a lot of times we'll get people that come in to visit us for the first time and we'll talk about this. And I say, well, what did your advisor tell you? He said, well, we have to go see our tax person. They're not in a position to give advice. I'm not giving advice either. I'm just laying out what it is and what maybe some of your options are. So it's good to know that. You know, it's like having a map, and they don't make maps anymore. It's like having a GPS that says, if you want to go from here to there, this is kind of the best way to do it. You don't have to follow that way. You can do whatever you want to do. But why not just take advantage of what we're offering? Give us a call, 616-301-2581, and we'll help you. Or go to our website, www.cornerstone-rp.com. Put your name, number, phone number, and we'll contact you, and we'll help you. There's still time to do something. So take advantage of us and give us a call, 616-301-2581.
Well, that tax analysis, review, assessment, and planning certainly can be very beneficial. You can potentially identify strategies to save a measurable amount of wealth over the course of the years to come. And that can make an impact and a difference in your retirement. A lot of people just as concerned right now with the direction and the strength and stability of the market, along with the tax analysis. Of course, with Ron Corser and the team from Cornerstone Retirement Partners, they can do the investment analysis as well, helping you to better understand what you own, the amount of risk that you are taking, what you're paying in fees, the potential for upside, downside in the future, and how it plays into the larger financial and retirement picture, and they can help you review and evaluate the Social Security as well. Every aspect of your planning and your financial and retirement future, they can help you take a look at and provide you some guidance and insight. Pick up the phone, give them a call, 616-301-2581, 616-301-2581. Ron, always a good time sharing this information with you here on the program. We appreciate your guidance and insight and the education that you provide each and every week on your course to retirement.
Well, this has been fun. Taxes are that jungle thing that everybody doesn't want to go into because there's monsters in the jungle, but we can help sort through all of that. So give us a call at 616-301-2581. Other than that, have a blessed Sunday. We look forward to having you tune in again next week.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott & Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes.